Well, good afternoon. The time is now 2 o'clock, and I will call this August 21st, 2024 meeting of the Oklahoma City Deferred Compensation Board to order. Before we get rolling, one of the things the clerk has reminded me of is that we do have the microphones, and so if you do happen to speak, please turn your microphone on so that allows our participants who are watching from online to hear everything completely. So let's make sure the mics are on before you speak. Moving on to item number 2, that's to approve the minutes from the May 15th, 2024 meeting. Got a motion and a second. And the item passes. Number 3 is a presentation from Voya, and so we have the Voya Financial Education Strategy, and Trampus Bright from Voya is here, and we will pass this along to you.
Okay, sounds good. Yes, thank you, everyone. Again, my name is Trampus Bright. I work with Voya Financial. I'm responsible for the RFP, the process, and getting these documents here in front of you today.
Good afternoon, Board. My name is Gavin Grunberg. Been with Voya Financial for 20 years last month, and my responsibility is all of our business development and sales efforts in the public sector.
And I'd like to start by saying thank you, and I know this is the first time we've been in the same room since the finals presentation. Thank you for selecting Voya Financial, voting for us, putting your faith and trust in us, and leading your participants in this new chapter of consolidation. We feel like we have some fantastic tools and services we're going to offer, and looking forward to being a longtime partner with OKC. So what we put together here today is just a sample education plan. Again, this is it's not a static document. We'll continue to enhance this as we get closer to transition going live, and also in the years to come. So the first thing I wanted to cover, if we could turn to slide number 2. So first is the transition communications. You know, anytime you go through a consolidation, you select a new vendor, we want to make sure that we create a lot of excitement and buzz around Voya Financial. So we're going to offer a lot of communications to your participants to make sure they understand what the changes are, when the changes will take place, if there's any action items on their part, and then also giving them an opportunity to learn how they can go and ask questions about any of the transitions. So on this slide here, you know, it really starts with the original announcement naming Voya as the new provider. We'll have a transition notice we discussed today in one of our communications calls. As an ERISA practice, usually you'd want to get that notification out 30 days in advance of the go live date. In the government sector, we use that ERISA as a best practice. And so going forward with this plan, instead of using 30 days, we'd like to get that communication out 45 days in advance. We'll also have a transition website, so all of the materials that we provide to your participants will also be available on the transition website, any of the communications around what's taking place, etc. Our call center, the Voya Customer Service Center, will be turned on approximately right around the time the transition notifications go out. So they'll have access to our call center folks as well to have any question or any of their questions answered, and also have a lot of additional materials as well. On the next slide, we've already been discussing some of the upcoming benefit fairs. We have on the calendar the annual benefit fair for retirees, October 22nd and 23rd, and also for the current employees, October 28th through November 1st. During those meetings, or during those benefit fairs, we'll have a lot of group meetings so we can get education across, talking about the transition. There'll be some follow-up Q&A afterwards, but not really a lot of individual meetings during that time. And the reason for that is because the account's not open. There's not a lot we can do as far as going into participant accounts. But we'll definitely be at the booth answering questions, again, creating that excitement for Voya. And then at the very bottom of that slide, you'll see transition meetings right now tentatively scheduled for January 2nd through January 10th. We'll add as many meetings as we need when it comes to transition, and those will be both group, individual. We'll set up shop somewhere in the city as well, just for individuals to stop by one-on-one. So again, trying to give ample time to get any type of questions answered by your participants and employees. On the next slide, so when we talk about ongoing, our education, what was agreed upon is 60 days during the first year, and then 40 days after that, years 2 plus. Felt like there'd be a greater need at the very beginning. And also we have a lot of tools and technology that can answer a lot of questions for your participants. But the 60 days and 40 days, that's in person. And if there's a need for virtual meetings on top of that, we can accommodate those as well. But those, I just want to make it clear that the 60 days and 40 days, that's all in person. That'll be designed in both group and individual meetings. And also, all of those education meetings, we can attend different locations, different shifts. So we want to make sure that we meet your employees where they are and they can get their questions answered.
Are we supposed to reach out to you to schedule these locations for our individual departments, or is that something that you're going to schedule with, reach out to us and schedule those?
Yeah, we'll definitely reach out to you to schedule those meetings. You'll learn the history of the plan, kind of what locations are needed, when, where, timing, et cetera. We'll schedule those meetings. So if we have an office in a certain location for 4 hours, we can set up shop there. Then we can also have Time Tap. It's a scheduling tool, so participants can actually go on and schedule a meeting. That's a great resource because it allows us to track why your participants are coming in, kind of what's the topic of mind, what they're really interested in, and then we can report that back to you in a quarterly basis.
Okay. Thanks.
You have to be here? Is there going to be more than one rep, especially during this, when it merges over?
Yeah, so during the transition, we'll have additional resources to make sure, we cover different locations, cover the booth, because we suspect there'll be a lot of questions. A lot of people come up and we don't want a line out the door, so we'll definitely have multiple people here during the transition. Ongoing, we have a dedicated rep. We also have additional support as well from a second and third rep here in the area. Other questions? And then, the 60 days and the 40 days, that's what was agreed upon in the contract and also in the RFP. We put additional levels of education. So if we feel like year 2, 40 days is not enough, then we put additional pricing in there for additional days. But, if we go to 41 days, 42 days, 45 days, as long as within reason, there's not going to be an extra charge for that. On the next slide, again, this kind of just breaks down the 60 days and the 40 days of education. We put the hours here, so 60 days pretty much equates to 480 hours. We know if we come to fire and police, it may be during certain shifts. It may be an hour, 2 hours at a time, so we'll accommodate that. But hopefully on the back end of that or before that, we can schedule time here with general employees, so we're taking up a lot of the day. But we can be very flexible in the different shifts. And same with the 40 days. And when you look at year 2 plus, that's about 3.5 days per month. So we'll just structure that however is needed. So again, this is a very rough draft, and we'll do what's necessary to make sure we educate your employees.
I've got a question for you. On the year 1, the 60 days, is that transition period, that January 2nd, when it's pretty intensive, does that count against those educations?
It does not.
Okay.
It does not,
good.
yep.
Thank you.
Yeah, we want to do everything we can to again, create that excitement and buzz around Voya. So if we need to be here 20 days during that transition period, we'll do that. And that does not count against those 60 days. Other questions? So, I put some additional slides in there, slide 6 plus. That's just around, sample education calendars. Typically we would like to schedule a time to sit down and kind of develop out an annual calendar of what the education would look like. How do we support that with communications to make sure that we're not only meeting in person, but we're sending communications out, getting the topics and themes out that's important to you to make sure we accomplish the goals that you're looking for. Then we also have some virtual education models in there as well. But that's all we had prepared for you today.
Maybe just touch on that personalized piece, because it's based on what you're seeing from your data on individual participants where they could use perhaps targeted education.
Right, so, I think a benefit of Voya is with the fact that we use behavioral finance in everything that we do. A lot of that starts with understanding how the participant thinks, how do they act, and capitalizing on that. So we want to nudge a participant in making good, sound financial decisions. And a lot of that revolves around our automated emails and targeted emails. So for example, if I'm already in the plan, I probably don't need to receive an email communication or paper communication to enroll in the plan. So we want to always be providing that next best step. So that targeted message to me as an individual is going to be customized for me and me alone.
Occurs if our members do nothing. Will they, but they already have money in one of our other plans, will it roll over to just a target date fund or something, so it's just in that, or does it just sit in some sort of account? How does that work if they choose to do, if they just don't do anything for whatever reason?
That's a great question. I think we're going to talk about investments and mapping here momentarily with ACG. But yeah, there'll be a mapping schedule, so it'll be clear as far as what I'm invested in now and where that will go unless I make a decision to move it elsewhere, either before the transition or after the transition. So they're going to go through that mapping schedule.
Your email notification, is that going to include the retirees also on your initial email blast out? Because it just said anyone that's on file.
It is. Yeah, it will go out to retirees and active participants in the plan.
Okay.
So just to add to that, when we take over the data from Mission Square and Nationwide, we'll ask them for any email addresses they have on file so that we can then populate our system. And then as participants give us their email, if they don't already have it on file, then they become part of our database where we can communicate electronically.
Any other questions? Well, I don't see any more questions, and this is just a presentation, so there is no action that needs to be taken by the board at this time. So we can move on to item number 4, which is to receive the investment consultant report. Up first is the quarterly performance report, and we've got Jason Poolhouse and Kevin Moore from Asset Consulting Group here.
So we're probably just going to work from the plan lineup recommendations because I think you all have printed copies. So if we need to compare to current lineup options, we can. But just to back up and how we got to where we are today, the first step some time ago was the recommendation to create a governing body. That was created. You all are the governing body. To oversee the participant-directed plans of the city. As part of that, your fiduciary duty is to oversee and monitor record keepers, oversee the investment options, ensure that there is a diversified set of high-quality, low-cost options for your participants to create that want to choose their own asset allocation. As well as having a qualified default option for those that don't want to make a decision. Part of the recommendation that we made from the very beginning was really narrowing down the list of options to a reasonable set of investment options. Typically, we see one option per asset class. So to your question, Scott, what we're going to go through today is we've reviewed available options, and it's limitless with Voya or Nationwide or Mission Squared. We could go out to them and say, this is what we want to have on the platform for our participants. Do you have that available? And if they don't, they can make it available. It would just take some time. So we've worked the last several months on coming up with a set of choices for you all in every asset class that's covered, beginning large cap core growth value, small cap core growth value, fixed income, real assets, and what have you. So today, Kevin's going to go through this. There's a lot of information here. Ultimately, what we're trying to do, like I said, is get to a reasonable set of options that covers everything that your participants are in today, so that they have a high-quality option that's been vetted, not just from a performance standpoint, but there's going to be ongoing vetting of the organization, regulatory issues, legal issues, the team, the incentives of the portfolio management team, performance, risk, fees, all the things that we're regularly reviewing with fund managers. If there's changes with a fund manager internally, we may come back to you in the future and say we recommend that you make a change to this option. So with that, I'll hand it over to Kevin to walk through this material.
Great, thank you, Jason. And just for reference, I'm operating off of the plan lineup investment recommendations file. We have the two files here, but that's what we're going to be walking through here as part of this next discussion. There we go, that's perfect. And so just to take Jason's comments and bring it over into this set of recommendations. What we've outlined over these next number of slides is just ultimately where you were and where we're trying to go, consolidating the fund lineup from the numerous options that you have today across equity, bonds, and real assets, and make them much more reasonable, and going through the mapping exercise that you alluded to earlier, Scott. So the way that we've outlined this is first just going through what you have today, and then looking at a fee analysis, which ultimately encapsulates all the different options that you have across every category. A couple options where we think would make sense going forward from a transition standpoint. We have multiple options within each category for consideration, with the intent to ultimately select one within each of those categories. And we'll walk through the analysis that we went through. Ultimately, we know that a consolidation requires disruption. And so at the end of this, there's an agenda item that we'll also talk about self-directed brokerage about for those participants that still want to invest outside of the core investment lineup, wherever the board decides to go. So if we could go to page 6 and 7, just as a reminder, this is just ultimately depicting, where you are today from a global equity standpoint, all of the different options across Mission Square and nationwide, across value, core, and growth, U.S., non-U.S., global, and emerging markets. Page 7 shows you the fixed income options, the real assets options, and what we call the more balanced options. That's the target date funds, that's these balanced funds that have some in stocks and some in bonds, and you can see that across both Nationwide and Mission Square. Page 8 just gets at where we think the lineup should ultimately land. And you can see that's a pretty meaningful reduction in the amount of options. But once again, just from a fiduciary standpoint, as your investment consultant, these options are being monitored on an ongoing basis, and there's being due diligence done for any options that are offered within the plan. Page 10 is really the start of the fee analysis that we underwent, and there's a lot on these next few pages, so really just want to walk the board through what you have on this page and what we're ultimately depicting here. What you have on the left-hand side of page 10 are the current fund options. You see the record keeper there, whether it's Nationwide or Mission Square. You have the current market values of every option there. You have the fees in percentage terms, and then you have the fees in dollar terms. And this is solely focusing on U.S. large cap equity. So what we have here, if you just focus on kind of that top part on the left-hand side, U.S. large cap value has 5 separate options across the 2 record keepers. You see the different fees there in both percentage and in dollar terms that are being paid by participants currently. That's an investment management fee, and these balances are as of 6/30. And as you go down to core, you can see the numerous options within U.S. large cap core, and then similarly in U.S. large cap growth. And what we did was we took the fee column in dollar terms, added all of those investment management fees up across each category. So for U.S. large cap value, that $214,017, we added it to the U.S. large cap core fees currently being paid of $237,000, and added it to the U.S. large cap growth fees being paid, which is a little more than $805,000, to total that $1.257 million being paid in fees. Now, it's important to note here that U.S. large cap is a very popular place for participants to invest their money. It's done very well over the last decade plus at this point, and when you look at underlying asset allocations for participants, that's going to generally be the largest weight. When you get over to the right-hand side, when we look at U.S. large cap value at the top right-hand portion, you see the two options there, Vanguard Windsor 2, MFS Value. Those are the two investment managers that we think the board should consider with the intent of selecting one U.S. value manager within the plan lineup. So we have the fees laid out here in percentage terms. We have the fees laid out in dollar terms, and you can see that mapped market value to your point before, Scott. This is assuming that participants' balances that are currently in U.S. large cap value funds at Mission Square and Nationwide are going to be mapped over into one of these funds.
So that's what would occur, to your question before. If they do nothing, if you have money in one of the large cap value funds, it's going to be mapped to the large cap value option that is selected. Straight across.
If they do nothing.
It's going to go to the target date
Correct.
fund that they're, based on their, whatever they're in today.
Correct. And you'll see that over the subsequent pages. We have that laid out by category. So just sticking with U.S. large cap value here, you see the fees in dollar terms over on the far right-hand side for Vanguard Windsor 2 and MFS Value. Vanguard Windsor 2's fees come in at $76,000, assuming that all assets are to come over into that fund and paying that 0.26% fee, or 26 basis point fee. Similarly with MFS Value, if all of those assets were mapped over into the MFS Value Fund at 41 basis points, or 0.41%, that investment management fee would be at a little bit more than $119,000. Below that, you can see the U.S. large cap value fee range, and all it's doing is just showing you the least expensive option, what that costs from an investment management fee standpoint. You see that $76,000 is right there. And then on the right-hand side, we have the more expensive option of the two. So we followed a...
But you compare that to what currently is being paid for large cap value exposure, it's significantly less. One of the things that it's important to point out here, just because you have, from a diversification standpoint for an individual investor, having diversifying across 5 large cap value funds is not providing diversification. They're all really essentially doing the same thing. Just to point out here, because what we tried to do is if we were comfortable in our due diligence and underwriting of one of the existing options, particularly one that had significant assets, we wanted to include that as one of the potential options. So you'll see that MFS Value Fund is the MFS Value Fund on the one of the two that we're proposing. It's the same strategy. It's simply not a revenue sharing strategy where the record keeper is getting a portion of the fees. So the difference in cost is about 13 basis points, which is pretty significant for the same strategy. So that flows directly through into performance when we look at the performance of the funds.
So we have the ranges laid out for U.S. large cap value, as you see there. Similar exercise done for core and for growth. A couple things to point out on the U.S. large cap core side. What we're showing here for consideration is a passive strategy, just an S&P 500 index fund, very low cost. You can see the two candidates that we've considered here. Northern Trust comes in at 1 basis point, and Vanguard's large cap index fund comes in at 5 basis points. A A couple of the index funds that were offered in the current lineup are significantly higher from a fee standpoint, with the Boney Mellon S&P 500 Index Fund coming in at 50 basis points, Nationwide S&P 500 Index Fund coming in at 44 basis points, Mission Square Broad Index Fund coming in at 19 basis points.
Question, I just kind of curious, this American Century Equity Fund, if that's our, our largest market value, why wasn't that brought over? Was it just not as?
I'm sorry, can you say that again?
Up at the large cap values, that American Century Equity Income Fund, is that what we have most of our monies invested in? And then why wasn't that brought over if that was the case?
Within large cap value, that is the highest balance. From our work as investment consultants and reviewing the platform and available options, we feel very strongly about Vanguard, Windsor II, and MFS Value. We think those are really good funds. We think those are better solutions here than using the American Century Equity Income Fund. So you'll notice that throughout, that it's not always going to be the highest balance within a category that came over, but we certainly looked at everything, and we didn't automatically dismiss anything that was being used. So just picking that up on the U.S. large cap core fee range
Kevin?
side.
Another
I
question.
apologize, I just
Sorry,
wanted
Amy.
more question. So just with that, with the transition, what was the basis that would disqualify one of the ones that we've got a large balance for? What were some of the things, the considerations you took into?
Yeah, so we looked at performance. We looked at just the way that the strategy is structured, whether it's active or passive, whether or not the fees are appropriate given that strategy. Those are going to be the main three things.
So the American Century Equity Income Fund, on a 3-year basis, which is the longest period for that fund, and I'm looking in your quarterly report, it's underperformed the median by about 3%, ranking in the 91st percentile. So it is a bottom 10% performing fund over the last 3 years. The Vanguard Windsor Fund, over that same time period, up 7.85, outperforming the benchmark by 2.3% in the top quartile of funds. Not that we're wedded to Morningstar rankings because we're doing our own evaluation, but that American Century Fund is a 2-star Morningstar rated fund, and the Vanguard Windsor Fund is a 4-star fund. So just because we looked at those that had significant assets, and if it made sense and we felt from an underwriting standpoint they were a high quality option, then we wanted to include it. But just pointing out those couple of things.
So just from a fee standpoint, if you look at U.S. large cap core on the right-hand side, you can see that fees can be pretty significantly reduced regardless of which option you go with. You see that fee range of $4,645 up to about $23,000 if you were to go with the higher fee option there. Down in the growth side, Scott, to your point about there being a lot of assets in a particular option and then potentially being here for consideration. The Fidelity Contra Fund is a perfect example of that. So there's currently $60 million in the Fidelity Contra Fund across both Nationwide and Mission Square. It's a fund that's offered on both plan lineups there. We did our due diligence on the fund. We like the Fidelity Contra Fund. We worked with Voya to come up with a lower fee share class option for this plan. And so we certainly want to have them amongst the two candidates for consideration. That fee that was being paid at Mission Square and Nationwide was 39 basis points. And after going through the vehicle due diligence with Voya, they are able to offer a 32 basis point option, same exact fund. So if you look on the right-hand side, still in that growth category, we got the Fidelity Contra Fund there and the Loomis Sales Large Cap Growth Fund that comes in at 57 basis points. And then you see that large cap growth fee range down below of $415,000 up to $739,000 for large cap growth. Once again, that's because that's where a lot of participant balances are going to reside because large cap growth has done so well.
One of the things we should probably be helpful to mention before we keep going through, and I think it was probably on the first page, in the core space, we're proposing a passive option in every asset class, simply to have a very low cost index fund option for participants to choose from. We think in the best practice in participant-directed plans, that's generally what we see. And then we'll have active managers, fundamental, bottom-up stock-picking managers, and growth and value for those participants that want to choose to combine those types of strategies. So those fees will be a little bit higher. But in the passive index, they're all the same. So the BNY Mellon S&P 500 fund and the Mission Squared S&P 500 fund and the nationwide S&P 500 index fund, they're all doing the same thing, owning the same 500 stocks. So there, it's really lowest cost and most liquidity. And that's why, I think there might be some questions of why why we're Northern versus a Vanguard fund, and it's really where we can get the lowest cost there.
So rolling all of those fee ranges up as you just follow down the page on the right-hand side, if you were to add all of the lowest expense ratio options across value, core, and growth, you come down to the fee of $495,960. If you were to take the higher fee option within each of those categories and you were to add those up, you get to $739,661. So what we did was just simply add all of those up down in that proposed participant U.S. large cap fee range there, 495,960 and 838, excuse me, and subtracted that from the 1.257 million to get to those green boxes down below of potential fee savings. And as you can tell, it's a pretty wide range there. And there can be mixing and matching of those options, and that would fall somewhere in between. Once again, in large cap, this is going to be the most pronounced area of fee savings because participant balances are going to be skewed towards large cap stocks.
And the savings piece, they're flipped basically from lowest savings to highest savings,
Correct.
but the highest savings
It's
is
still
from the
savings.
lowest fee, just to, in
Right.
terms of they're not underneath the ones that
Correct.
they're right.
Correct.
Yeah, yeah.
Correct. It's just to lay it out so
Yep.
you can read it easier left to right.
But because we have so much to go through here, it might be ultimately we would recommend one in each of these categories, and just might be helpful for us to opine on which ones we think as we go through this. It's not always going to be the low cost, but I think for these three categories, it is.
Mm-hmm. Absolutely. So within U.S. large cap value, just while we're looking at page 10, our recommendation of the two funds that you see between Vanguard Windsor 2 and MFS Value would be Vanguard Windsor 2. Very high quality fund, very low cost because of Vanguard's scale. As Jason alluded to before, performance has been exceptionally strong consistently over time. Within U.S. large cap core, our recommendation once again will be the low cost here because it's an S&P 500 index fund, and we would recommend Northern Trust at 1 basis point. And then on the large cap growth side, maintaining that Fidelity Contra fund as an option for participants at that 32 basis point fee. Any questions on that before we move forward? Okay, so on page 11, same layout here, but this is going to be focused on U.S. small and mid-cap stocks. So once again, lots of numbers on this page, but same concept as we just walked through on the large cap side. Have a lot of options across small, mid-value, small, mid-core, and small, mid-growth. I know small and mid is something that we do want to talk about a little bit more. You have dedicated mid-cap and you have dedicated small cap across these categories. From a lineup consolidation standpoint, we think it makes more sense to offer small and mid-cap options that can do both within one selection. So we're trying to cover the same amount of ground with less line items or choices for participants. So when you look at the top left-hand portion of this chart, U.S. small mid-value market values and fees, currently participants are paying a little bit more than $106,000 in investment management fees on the value side. On the core side, a little bit more than $28,000, and on the growth side, a little bit more than $313,000, which all adds up into investment management fees being at that $448,000 amount. On the right-hand side, when you look at the two candidates that we'd like the board to consider, you see Victory Integrity, small mid-cap value, and River Road, small mid-cap value. Those fees for Victory Integrity are at 83 basis points, or 0.83%, and for River Road at 0.98%. So once again, small, mid-cap, more coverage there. There is going to be a little bit of a differentiator on the fee side. Broadly speaking, if you were to have a small cap only fund, that's going to be more expensive than a mid-cap only fund, which is going to be more expensive than a large cap only fund. So small and mid combined are going to have you fall in between mid and small cap from a fee standpoint. On the core side, the two candidates that we'd like the board to consider, once again, are passive. They're going to be index funds, one with SSGA at 5 basis points and one with BlackRock at 7 basis points. And then on the growth side down below, you do see a dedicated small cap fund here with Neuberger Berman, that's the Genesis Fund. That is the same fund that is offered over at Nationwide, currently offered at 1.09%, if you see that in the middle of that bottom category there. Without the revenue sharing and with working through Voya through vehicles, that same fund can be offered for 0.74%. Same team, same strategy, same everything. There's currently a little bit less than $4.5 million in that fund too. So when you add up all of the fees here, you can see down below the fee range for the proposed options. If you go with the cheapest option across all these categories, would be a little bit more than $360,000. Most expensive option in each of these categories would land you right about $410,000. And from a savings standpoint, once again, this is going to be less pronounced than what you saw on the large cap side, but that fee savings ranges from a little bit less than $40,000 to a little bit less than $90,000.
It's less pronounced because there's less assets there.
Yeah. So I'll stop there and just see if there's any questions on that. Okay. Well, just going through the categories then and just letting you know our recommendations across each category. Within small mid-cap value, we'd recommend Victory Integrity. Within U.S. small mid-cap core, once again, going with the lowest cost index fund option here, that's going to be with SSGA. And then on the growth side here, you have assets with Neuberger Berman's Genesis Fund. That's a pretty significant fee savings from what you have today. That is small cap only. So I think this is an area for discussion. We would tend to lean towards small to mid cap though, once again being more flexible in the implementation. So we would lean towards Loomis Sales for that, but we fully understand if the board would want to maintain Neuberger Berman, just because it is an existing option.
Any questions or discussions about that?
I guess, yes, the question would be, are we to be kind of discussing our recommendations now, or kind of when we get done, then we'll go through and?
Well, we'll do it again, but we're just in
Okay,
the
just wanna make
effort,
sure. Okay.
interest of time, we're trying to, and I don't know if we want to go to that. From a performance differential, this is on page 18, just to eyeball that. I mean, part of this is the differential just between SMID and small. So near term, the last year, having more mid-cap exposure has helped. And so you'll see that 1 year, the Loomis SMID growth up 11%, or the Neuberger Berman Fund up 6.3%. But if we go out over 7 years, that's the longest common time period, they're both about the same. It's more from an exposure standpoint that why we would lean toward a fund that gets you exposure to both small and mid growth.
Going back to page 12, this is the global equity and non-U.S. equity categories that are currently offered in the plan and what we're recommending for consideration here. Same layout as we talked about over the previous pages. When you add up the global, non-U.S. value, non-U.S. core, and non-U.S. growth, it gets to current fees on an investment management standpoint at a little bit more than $412,000. When you focus on the global equity category at the top, we are recommending a passive strategy here. Low cost, just exposure to the global equity markets. You know, some participants are going to want to do U.S., some are going to want to do non-U.S. only. This is a nice way to just offer broad exposure. Both of these managers come in right at 10 basis points, so that's with SSGA and Vanguard for the Total World Index Fund. On the non-U.S. value side, 2 active managers, once again, to Jason's point, before we like active managers on the value and growth sides of the lineup. Columbia and Causeway offer some pretty significant fee savings versus what is offered today in non-U.S. value, with Columbia being offered at 0.38%. On the non-U.S. core side, so just to be clear here, this is for stocks outside the U.S., whereas the global equity includes the U.S. And on the non-U.S. core side, we have SSGA and Vanguard here again at very low cost, 5 basis points and 12 basis points. Non-U.S. growth, William Blair and Harding Loevner here. This includes emerging markets within their strategies. So once again, it's meant to consolidate the offerings while still maintaining exposure. And when you add up all the fees for what we're bringing for consideration, you see the fee savings in the green boxes ranging from $185,000 up to $258,000. Within each category here, we would recommend SSGA's Global Equity Index Fund within the global category. Once again, it's the same fee, same exact fund as Vanguard, so you can't go wrong there. On the non-U.S. value side, we would recommend Columbia Overseas Value. That's a really good fund for a very attractive fee at 38 basis points. On the non-U.S. core side, we'd recommend the SSGA All Country World ex-US Index at 5 basis points. Very low cost for that. And then on the non-U.S. growth side, the William Blair International Leaders Fund. That's been a very strong performing fund. William Blair has a really strong team there as well. Any questions on that? Okay, then just on page 13, sorry the font gets a lot smaller here, but we cover a good amount of ground here. This covers fixed income, this covers real assets, this covers balanced funds, and this covers target date funds. So there's a lot of options being offered currently across all those categories. When you take everything, look at the fees, roll all of the fees up from a dollar standpoint, you can see that based off how the lineup is currently constructed, investment management fees come in at a little bit more than $567,000 today. When you look at the top here, same structure as before. We're able to get a lot of much lower cost options that are what are currently being offered today. Starting up top at core fixed income, these are 2 actively managed core funds, so U.S. investment grade bonds, very high quality strategies offered by Baird and J.P. Morgan. Able to get both of those at 30 basis points, so that's a really attractive fee for that type of a fund. When you look at the next category, which is opportunistic fixed income, I think it's important to note here that this type of a strategy can do a lot of different things. It can do things like high yield, it can do things like TIPS, non-US bonds, so it takes some of the more segregated options that are offered today and wraps them up into one offering. Once again, just sticking with that same theme. We have Pioneer here at 60 basis points and Carolyn Reams at 40 basis points. And one thing to note here with the Pioneer Strategic Income Fund, the fund that we're showing here at 60 basis points is a mutual fund. There is an opportunity to potentially add a CIT vehicle, a collective investment trust for retirement assets only at 35 basis points. That's just something that we would have to work
It's
through.
just not set up on the Voya platform right now,
Yeah.
but we think we would anticipate it could be set up within several months, and it's the same strategy, significantly lower fee.
So that would be just something to point out as we go through this. One area for a little bit more discussion is going to be this real assets category. So currently on the real assets side, you have REITs, so publicly traded real estate, and you have an inflation-focused fund that falls into this category, which can be a variety of different things, really. But the way that we thought about real assets for this plan and how we look at it at other plans is real assets, if you're looking to consolidate exposures into one option, covers a few different categories. So with the PIMCO Diversified Real Assets Fund that we're showing at 41 basis points, it gets exposure to TIPS, so Treasury Inflated Protection Securities. It gets REITs and commodities all rolled up into one at a pretty attractive fee at 41 basis points. The Principal Diversified Real Assets Fund is slightly more expensive at 78 basis points. That includes TIPS, REITs, commodities, also includes publicly traded infrastructure assets, also natural resources in the form of stocks, what we call resource equities. So it's a lot of different things underneath the hood for those strategies to be a little bit more diversified than just say a straight commodities or a straight REITs option. So it's
The other thing to point out here is that this is lightly used today, and we would anticipate it would be limited use by participants, but we want to have a diversified option for those participants that want to have it.
yeah, outside of just traditional stocks and bonds. So we've included those two strategies that are very widely used in defined contribution plans for the board's consideration. The next category is another area where we want to talk about quite a bit. This is the balanced fund category. You can see on the left-hand side, you have a lot of different options across Mission Square and nationwide. Aggressive funds, moderately aggressive funds, moderately conservative, and conservative funds. And all that is just different asset allocation splits across stocks and bonds, depending on what the underlying participant prefers. And we think there's just a better usage of that, and that's with the category underneath it, the target date funds, where you use that as your default option. Participant that doesn't feel comfortable picking their own asset allocation goes into the target date fund suite, and then those allocations are managed for them instead of picking a particular risk tolerance for yourself.
And really, over the last 15 years, there's been an evolution in participant-directed plans to move more toward the target date retirement funds and away from risk-based balance funds, just because of what Kevin described. The risk in a target date fund adjusts over time based on the participant's age, as opposed to the participant having to decide, when I'm 20, am I conservative, moderate, or aggressive, and then maybe forget about it, and when they're 60, they're still in the aggressive strategy. The target date funds adjust over time. So typically we wouldn't have all these options, and you don't see that in participant-directed plans really much at all anymore.
We did think it just makes sense to keep one in there on the right-hand side. So you have the American Balance Fund and the Dodge & Cox Balance Fund. Those are generally going to be 60% stocks, 40% bonds, what we would consider a moderate allocation. So once again, just straight down the middle. If participants do really want that only stock and bond split at 60-40, one of those options could be maintained. And then lastly, the target date funds here, you got the nationwide index funds and the Mission Square target date funds. The nationwide target date funds are index only, so they're passive, come in at 49 basis points. The Mission Square target date funds do have an active component to them, which is why you see those fees be a little bit higher at 60 to 69 basis points, just depending on the year. What we recommend within target date funds is a passive implementation. You'll see the two index fund providers here with SSGA and Vanguard. Both of those are passive. They're very easy to understand, explain, digest. You're getting the market returns while the manager is managing those allocations for you. So Vanguard, as an example, that's 7 basis points. There's 5 asset classes within them: U.S. stocks, U.S. bonds, non-U.S. stocks, non-U.S. bonds, and then TIPS is added to the end of that glide path as a participant gets close to retirement. SSGA has a similar approach, but just divvies up the equity and the bond allocation. So there'd be U.S. large cap, U.S. small cap, non-U.S. developed emerging markets, core bonds, opportunistic bonds, and TIPS. So it's just a slightly different way of looking at it. Because SSGA divvies it up a little bit more, you see their fee being 2 basis points higher at 9 basis points. So very cheap, regardless of which fund you ultimately go with, but both are great options and widely used in the DC space.
Just want to confirm, because we had a question come in on this when this lineup came out, that these would both be suites of options, and so
Correct.
it would have the 2020, 2025, 2030, et cetera.
Correct, yes, from the target retirement option all the way to the 2070 funds that are out now.
The other
And-
thing, and I'll just raise this now because, and the Voya folks can probably chime in on this, but when we look at account balances and how much are in the target retirement funds, it's pretty low. We would typically expect to see a lot more in target date retirement funds across a participant-directed plan. And that might be an area that's ripe for either broad education or targeted education to drive participants there.
So just going back category by category, once again, just to give you our leanings within each area. Within the core bond side at the very top, both are coming in right at 30 basis points, but we would recommend the JP Morgan Core Bond Fund, very high quality fund, very well tenured team, strong performance over time. Within the opportunistic fixed income category, we would recommend Pioneer. And once again, that would be an area where we would look to get a lower fee vehicle in place there. Within the real assets fund area, we'd recommend PIMCO. Once again, that's TIPS, REITs, commodities, comes in at 41 basis points. Within the balanced fund category, we recommend American. It's 25 basis points for that 60-40 split. And then on the target retirement fund side, we'd recommend Vanguard at 7 basis points. All-in fees, once again, I didn't touch on this at the very bottom. Within all of these categories range from roughly $271,000 to nearly $364,000.
Hey, Kevin, real quick, on going back onto the target fund fees.
Yep.
If we follow Jason's, and I agree with his recommendation, if we're going to try to move more of our participants to the target date, those fees are still going to be based on the 7%, but the dollar amount may increase because we'll see the movement across the funds, correct? Okay.
But you're not going to tell them what to do. Participants are going to do what they choose to do, but typically that's going to be the qualified default option, where if a participant doesn't make a decision on how their contributions are allocated, it would go to the target date retirement fund based on their age. And then just through broader education, we generally see that target date retirement funds make up a much larger percentage of these types of plans. So that's going to drive down participant costs as well.
Kevin, can you elaborate on one thing? When you spoke about and I believe that was under the opportunistic fixed income and the Pioneer strategic income, there was the possibility for the collective investment trust.
Correct.
If that option is selected, and that CIT option becomes available later on, would there be an additional action from the board to get into that share class? Would that be something automatic? How does that work in a plan like this?
There would not need to be additional action. That would just be something that we would be working on mechanically behind the scenes to make that available for investment on day one of the transition. So we would not view that as a second action item. And then just to wrap everything up on page 14 for the fee analysis part, we took the ranges across all those pages we just looked at and added them up. And you can see when you total the least amount of savings to the most amount of savings, once again, that range is very wide, but ranges from $869,000 up to that $1.47 million from an investment management fee standpoint.
That participants are paying, and that's per year.
And can you confirm that this is separate and in addition to the record keeper fee that you've spoken about in the past?
Yeah, so the record-keeping fees and these investment management fees get very entangled, which is the challenge. You have to go through each agreement that's in place between manager and record keeper and ultimately try to unwind all of that. There's going to be some overlap here with the revenue sharing, but there is certainly additional fee savings on top of what's already been experienced through the record-keeping review process.
These are from some of my members just asking, I've showed this to and got some opinions, quite a bit actually. Why were Vanguard funds, some of their questions, why would that just, the whole suite of Vanguard stuff not as an option? Because it typically seems that Vanguard will usually score very high up there, and then on some of these, we only have a 3-star rating, and I realize that just may be the sector that's just not getting a good rating, but there's always seems to be some 4- and 5-star rating funds, and yet on some of these choices, we only have a choice from 2 funds that both have a 3-star rating.
Sure. So to start with the Vanguard side of things, we look at all of the funds that are available within each category, and Vanguard is being recommended across a number of these categories. It's not going to be one where we recommend them in every situation. For some of these index funds where we're recommending Northern Trust or SSGA, it's just simply a cost thing because it's the same thing. And with some of these categories, based on how your participants are currently allocated, there's minimum investment amounts that come into play. So we have to take all that into consideration here. We really like Vanguard, which is why we're recommending them in a number of places, but that's going to be the driver for why they weren't used, particularly on the passive side. To Jason's point before, we like to have the core options, at least on the equity side, be passive strategies, and on the growth and value end of the spectrum, be active. And so with Vanguard, we have Vanguard Windsor 2 on the large cap value side, but they're not going to be as big of a player on the active side of things.
Then the Morningstar question, so I'm not sure which funds that we're landing on.
Like the U.S. small SMID cap value, those are 2 3-star funds. The River Road and the Victory Integrity. My question was, just from a 3rd grade education type is, are there not any 4 or 5-star funds that we could have given choices from? And then I didn't even take into account what he had said, that if we don't even meet the minimum amount of money that we can put in that fund, this may not even be an option to us.
Yeah, so the Morningstar rankings are helpful as supplements to what we do, but we wouldn't consider it to be the end-all be-all by any means. These Morningstar rankings do change from quarter to quarter. We've seen Loomis and River Road be at 4s and 5s in the past. This is just as of 6:30. We do want to make sure that we're not recommending a consistent 1 or a 2.
What I would point out is their long-term performance and peer group rankings. So if you go to page 17, and you look at River Road's SMID value, for 10-year performance of almost 9% versus the benchmark 6.2, the median This mid-value fund up 6.58, they're in the 5th percentile, meaning they're outperforming 95%. Victory, Integrity, similar, top quartile over a 10-year period. We're very familiar with these two teams and two firms. Spent a lot of time on the ground in their offices doing due diligence, and we're very comfortable with them. Yeah, I think and Kevin, you can correct me if I'm wrong, as I went through and looked at common period performance, all of the funds that we're proposing have, and a lot of it is because they're lower fees, have better performance as of the end of June than the funds that that your participants are currently in. There might be, oh, you said I don't.
Yeah, I mean, if you look at the longer-term rankings here, you see pretty consistent low numbers. Just as a reminder, 1 is the best and 99th is the worst, and you tend to see some pretty consistent low numbers over 3, 5, 7, and 10-year timeframes. Nearer term gets a little bit more volatile. Those move around a little bit more, but the funds that we're including for consideration are generally strong performers in each category.
I also wanted to make sure that our funds had a ticker symbol that our members could follow. 'Cause some of these, there's no ticker symbols limited, and then you search for it, you can't tell what share class we're in.
Yeah.
And that was a problem with our old record keepers, is some of them don't have ticker symbols at all. And that made it pretty
That's
ambiguous
the
as to
issue
what
with
you're
what
looking
we
for.
just talked about with Pioneer, the going into a CIT. That would Pioneer, the fund, the strategy. There is a mutual fund with a ticker symbol. That's what we have today. But we can get a 50% discount to the fee for the same strategy in a collective investment trust that would not have a ticker symbol.
Okay, well, maybe that just means if we go that way, we need to do a good job of educating our people as to what that means, because on Nationwide, you can't tell. There's nothing about it. So it'd be nice to say, this is the reason why I went to this, the underlying fund is this fund, and if you really want to track it, you could track it with this ticker symbol. I'm guessing that would be correct, minus what the fees would be.
And maybe you all want to just comment on that, just in terms of what you could see on a daily basis going on to the Voya platform.
So for all of the investment they've talked about here, you see they've got ticker symbols listed. So certainly those can be accessed via the web, newspaper if you're so inclined. If you did move to the CIT, then you wouldn't have a ticker symbol. But on the Voya website, you'll be able to click on the name of that fund. It links you right to a Morningstar fact sheet. So we're going to provide the same data someone would find through an online search of a ticker symbol. They just would do it through us instead of through the web or the newspaper.
Okay, and that was another kind of a broader question that I've been asked with my members as well, is when will they be able, Nationwide account at 9 p.m., I can see the rebalance of if I made money or lost money that day. But I have no way of seeing which funds made money or lost money unless I go find my ticker symbols, put it in a different app to see if I made money in this sector or this sector. How does Voya want to do that? Or what is y'all's kind of standard?
Sure. So we're going to provide daily valuation in each participant's account, so they'll see the fluctuation in the value based upon that market day's movement. We, of course, can't do that until the market closes. We need fund prices from all the different mutual fund families. We also provide on the website a listing of all the options in the plan with their daily price, net asset value, so you can see there what did the price do intraday or from day to day. So either the total performance in the account, total performance in that particular fund, or you can look at the share price of the fund and see how it fluctuated. Should be pretty simple.
Thanks.
Kevin, could you do a brief, or Kevin or Jason, really either, brief description of the CIT, just so the board completely understands what that is and maybe why that's different than maybe what the underlying fund is for that in that situation?
It's not different than the underlying fund. It's just a different type of vehicle. CIT stands for Collective Investment Trust. Oftentimes, fund managers will create those. They can only hold qualified plan assets. So whereas the mutual funds with a ticker symbol, all retail and institutional investors could go into that. The CIT is just qualified plan assets, and they generally can offer it for a much lower cost.
I had a question on the target base or target date funds. So we were active strategy on that, or we've been these other funds that we've been currently in?
So
No?
the nationwide funds, the NCIT index funds, those are all passive.
Okay.
Let's go back to page 13. So you see the NCIT index funds and the range of years there. Those are going to be it's 10 asset classes, all index funds there. For the Mission Square target retirement funds, there's going to be certainly a passive component there. Once again, it's right around 10 asset classes, depending on which vintage year you look at. But there is an active component to that, and that's why you see the fees jump up relative to the nationwide funds and be in that 65-ish to 70 basis point range.
But any target date fund suite is going to actively adjust the risk in those target date funds over time. They're not utilizing active strategies underneath, but they are adjusting the risk in terms of fixed income equities and other strategies.
Like rebalancing, essentially?
Yeah, as the 2060 fund right now is going to be probably 80% equity, 20% non-equity. When we get to 2050, it's going to look very different. It's going to look like the 2030 fund does today.
Okay. I guess I was trying to understand, like, evidently with Nationwide, we had, those were passive, but the Mission Square ones weren't. Is there an advantage one way or the other?
Well, it's going to be a difference relative to a benchmark and peers within the target date fund category. Just like with any other category, active management does things differently. So there's going to be times of outperformance or underperformance, whereas if you have an index fund, target date fund suite, you're just getting the market, but as Jason has alluded to, it's just changing allocations over time. So you're never having to try to figure out why your fund may look so much differently than peers.
And the most important part of those target date funds is that participants are in a fund that has sufficient risk for their age. Risk being equity, assets exposed to equities over time. Because that's going to drive 90% of the return of the fund, rather than how much Apple or NVIDIA it has today.
Is the fact that the Mission Square strategy was an active one why there's the range of the manager fees there on that between, it looks like 56 basis points to 69, and so since we're going with a passive strategy, would everything be that 7 basis points or 9 basis points
Yes.
within the suite? Okay.
So there's really no reason to be in an active strategy for those?
For the target date funds, our preference would be for a passive approach.
And that's because?
Because the real benefit is just adjusting the risk in the portfolio over time. And not taking just individual manager-specific risks that could create dispersion in the short term from the asset allocation.
So the additional services that Mission Square was supposedly or was providing aren't worthwhile in your opinion. Is that a fair statement?
Yeah, yes. I mean, we just don't think that the underlying approach for target date funds is best suited with active components in it. It's our preference and our recommendation that you utilize a passively implemented target date series where the manager, SSGA or Vanguard, is managing those allocation splits depending on the age. And that's the only, quote unquote, active part of it.
And I guess I would think of it kind of like how you've done it with the core funds for large cap. The core funds are passive, and that's what you would have in the target date fund is just a core,
Correct.
basically allocation. You're not trying to get growth or value, you're just trying to get a bit of everything.
Correct.
On the target date fund, what was your recommendation again?
That's going to be Vanguard.
Vanguard, okay, thank you.
Any additional questions for Asset Consulting Group? And I guess I should say, we do have the self-directed brokerage option, but that really is not necessarily a conversation with you on that. And so we can have that conversation towards when we get that on the agenda.
Okay.
All right. So we do have a couple of housekeeping things that we need to do as we move forward, because we do have the 2 reports. And so can we get a motion to receive the quarterly investment report? Got a motion and a second? Passes, and the next would be to receive the plan lineup investment recommendations. And from the board, I do want to say thank you very much for getting those to us 2 weeks ahead of this meeting. That was extremely helpful from a planning standpoint to making sure we could have adequate time to look at this, because it's a major component of what we're doing here. So I do appreciate you getting that to us in a timely manner. So that was extremely helpful from a board standpoint. As we move into item 5, which is items for individual consideration, what we have is we have the fund lineup, just starting with the U.S. large cap value investment option all the way down. And so really what we would have is discussion at that point, and then we would see take a motion to select one of the 2. And then we would vote on that, and we will do that for each one of these selections. And so I guess we would start that out with the large cap value investment option between either A, Vanguard Windsor 2, or the MFS Value Fund.
So do I just need to make a motion then? So which one do we want to discuss, or how do we do?
Yeah, so we would have the motion, and then motion a second, and then I guess we would have discussion, see if there's any discussion for it, and then vote. Clerk, would that be so that would be the process from that.
Can I make a motion to pick the Vanguard Windsor 2 fund then?
So
I'll second that.
we have a motion and a second for the Vanguard Windsor 2 fund. Any discussion about this particular? If not, we can go ahead and call the vote. And Vanguard Windsor 2. Item B is to select the U.S. Large Cap Core Investment option between Northern Trust S&P 500 Index Fund and the Vanguard Large Cap Index Fund.
I'll make a motion to select the Northern Trust S&P 500 Index Fund.
A second.
Any discussion?
Sorry, I messed you up.
No discussion on that. Please cast your votes. And the item passes. Item C would be select the U.S. large cap growth investment option between the Fidelity Contra Fund or the Loomis Sales large cap growth fund.
I'll make a recommendation to do the Fidelity Contra Fund.
I second.
We have a motion and a second. Any discussion for the large cap growth investment option? Seeing none, we can cast the votes. We can get this on the computer really quick. Okay, cast your votes. And the item passes. Item D, select U.S. small mid-cap value investment option between the Victory Integrity small mid-cap value or the River Road small mid-cap value.
I make a motion to accept Victory Integrity Small Cap.
Okay, I've got a motion
I'll second that.
and a second. Any discussion on this item? You may cast your votes. The item passes. Moving on to item E, select the U.S. small mid-cap core investment option between the SSGA Russell Small Mid-Cap Index or the BlackRock iShares Russell Small Mid-Cap Index.
I'll move the SSGA Russell Small Mid Cap Index.
Got a motion? Got a motion and a second for the SSGA Russell Small Mid-Cap Index. Is there any discussion on this item? Seeing none, you may cast your votes. And the item passes. Now, item F is to select the U.S. small mid-cap growth investment option. And this is the one where there may be some additional discussion required between the Neuberger Berman Genesis Fund, which did have the lower cost option on this, or the Loomis Sales small mid-cap growth, which had the small and mid-cap exposure on that. So we can have some discussion on this one, or we can take a motion. So I'll open up the floor for this particular fund.
I guess it feels to me like it's a little bit inconsistent to offer just a small cap fund when in the other areas we're doing small and mid cap. I feel like if we're going to offer a small cap fund only in this category, we ought to also offer a mid cap. And then that gets more complicated for people to choose from. So, I mean, at least I don't feel super strong about it, but it seems to me it'd be consistent to offer one that's a combination of small and mid cap rather than one that's just a small cap.
The only concern I have with that is that the Newberg Fund outperformed the small mid-cap fund consistently over the last 10 years, or 7, I'm sorry.
It's a fair point, yeah. Yeah, like I said, it's not the end of the world for me, but it just seemed to be consistent, so.
Well, it's not, the last year, the Loomis SMID growth outperformed Neuberger by 5%, and that's because the smaller end of smaller cap did not do as well as mid cap more recently. Long term, there's about 20 basis points differential. The Neuberger Berman on a 7-year basis outperformed Loomis Sales by 20 basis points, but they're doing a little bit different things.
Mm-hmm.
This is one I've talked to our members and even some of our vetted wealth advisors, and I got a 50-50 split on it, so it didn't really help, but it was kind of the same question we were talking about. You're gonna, we got a choice of a small cap growth, or you go ahead and do that SMID. So, I don't know. I don't have anything to offer.
From
I
a
just wanted to-
construction standpoint, that's why we were recommending the SMID. We think if you're offering options for participants, having a little bit broader option in the active space would be more appropriate.
And in the fund mapping, this is not an area where we have large balances currently. And so that may lend itself more towards just going with the small mid selection as well.
And then this next item, which is the brokerage window, if a participant wanted to have a dedicated small cap, they could do it there.
That was going to, so, with, you watch the market right now, if they think they're going to cut the rates, then people seem, the trend seems to think that the IWM, the Russell 2000, is going to go up. What would be some fund that our employees could pick? Would you have to pick a SMID and hope that kind of closely resembled an IWN type of a fund? If that's where you wanted to be, to believe that the market's going to rise in that area?
If you have participants that are really successful at market timing, small cap may do better. I would say if these are their long-term retirement assets, having a dedicated strategic asset allocation where they're not really moving around and sticking with it is probably the best bet. But historically, yes, we have seen when rates go down, typically small cap outperforms mid cap and large cap. But mid cap outperforms large cap.
Any other discussions on the small mid-cap growth investment options? Do we have a motion?
Well, I'll move the Loomis Sales Small Mid-Cap Growth as our choice.
Second.
We have a motion and a second on the Loomis Sales Small Mid-Cap Growth Fund. We've already had the discussion, and so you may cast your votes. It passes. Item G is to select the global equity investment option between the SSGA Global Equity Index or the Vanguard Total World Stock Index. Entertain a motion.
I'll make a motion to accept Global Equity Index.
We have a motion for the SSGA Global Equity Index. I have a second from Ralph. You may cast your votes.
Board member Yaw.
And it passes. I think we have had more votes in this meeting than the entire life of the board, so it is definitely good practice. Item H is going to be select a non-U.S. value investment option between the Columbia Overseas Value Fund or the Causeway International Value Fund.
I'll move that we select the Columbia Overseas Value.
Got a motion for Columbia?
I'll second.
With a second. Go ahead and cast your votes. And it passes. Now moving into the selecting the non-U.S. core investment options. We have the SSGA All Country World ex-US Index or the Vanguard FTSE All World ex-US.
I make a motion to do the SSGA All Country World ex-US Index Fund.
Second.
We have a motion and a second. And cast your votes. And it passes. Next, we have the non-U.S. growth investment option between the William Blair International Leaders or the Harding Loevner International Equity Fund. Any discussion or thoughts here?
I make a motion to accept William Blair International Leaders.
I'll second that.
Got a motion and a second for the William Blair. Any discussion on this item? Seeing none, you may go ahead and cast your votes. And it passes. Item K, we are now moving into the fixed income options. Select the U.S. investment grade investment option between the Baird Aggregate Bond Fund or the J.P. Morgan Core Bond Fund.
I'll move the J.P. Morgan Core Bond Fund.
Ralph seconds it.
Got a motion and a second for J.P. Morgan. You may cast your votes. And the item passes. Moving along to item L, select the opportunistic fixed income investment option between the Pioneer Strategic Income or the Carillion Reams Core Plus Bond. Entertain a motion.
I'll make a motion for Pioneer Strategic Income.
Second.
You may cast your votes. And the item passes. Item M, select real assets investment option. The options are the PIMCO diversified real assets or the principal diversified real assets.
I'll make a motion for the PIMCO diversified real assets.
Second.
Got a motion and a second for PIMCO. Any discussion? You may cast your votes. And the item passes. Next, select the asset allocation or balanced fund investment option between the American Balanced Fund or the Dodge and Cox Balanced Fund.
I'll move the American Balanced Fund.
I'll second it.
Got a motion and a second for the American Balanced Fund. You may cast your votes. And the item passes. Item O is to select a target date fund investment between the SSGA target retirement funds or the Vanguard target retirement funds.
I'll make a motion to accept the Vanguard suite of target date funds.
Second.
Got a motion and a second for Vanguard. Any discussion? Please cast your votes. And the item passes. Now, item P is slightly different because this is not an actual selection. Really what this is for item P is if we are going to incorporate a self-directed brokerage option within this. And I don't know if this needs to be a discussion with Trampus but we've got here, so Kevin's going to be up there, but Trampus is coming up as well.
Yeah, we were both just going to cover this. Just with all the consolidation, we acknowledge it's a lot of change, and we know that other participants that you're getting questions from and fielding questions from are going to potentially look to go outside of the core investment lineup. Now, one way to do that is through self-directed brokerage and through a self-directed brokerage window. We thought it made sense for Voya to cover their capabilities and their relationship with Schwab on that self-directed brokerage option if a participant does want to invest outside of the list of options that are being offered. So,
And I think, do we have a flyer in the packet there for the self-directed brokerage? That's it, yep. So our choice, our option here is the Schwab Personal Choice Retirement Account. Of course, we formerly had TD Ameritrade as well, but that was acquired by Schwab, so that's our primary option. Here's just kind of a Q&A as far as how that process would work. But pretty much the participant would first get signed up to choose to utilize Schwab, and they would go through the account access setup and all of that process. They would get a login, etc. And then they would get a link that would allow them to sell out of their assets in their retirement account and the core account funds, and then move over a certain percentage of those assets or dollars into the Schwab account. There can be some guardrails around that. Typically, we see 50% of the assets staying in the core funds, but we're flexible with that, so we can. It's up to really the board and ACG to determine what that limit would be. So then once you move money over to Schwab, then you can trade freely among the different investment options that they have within the brokerage option. And again, there's some other guardrails you can put in place to allow certain types of investments. For example, you may only want to offer just mutual funds, but Schwab will allow you to select from stocks, bonds, ETFs. There's a lot of different options that Schwab will allow. So again, another area that the board could implement some guardrails to however they see fit. If we go to the next slide, and one thing I'll mention, so there's well over 8,000 no-load mutual funds on the Schwab platform, 600 fund families. So almost any fund out there is going to be available through that Schwab platform. So if you do have the individual wanting to get the American Century Equity Fund, they can go straight into that fund through that Schwab website. Of course, they make it very easy to make the trades. You can do it either through your computer. They have a mobile app, and also you can call into the call center. The majority of funds, mutual funds, are no load, and those can be traded online for no additional charge outside of the annual $50 charge for the system connections between Voya and Schwab. So that's the annual fee a participant would pay if they did choose to invest in the brokerage option. But as far as making trades back and forth between mutual fund X and mutual fund Y, the majority of no-load funds would have no fees. If it is broker assisted, so if you want help making that trade, so if you're not doing it through your computer website electronically, there is additional fees for that. I think it's $25 per trade. There's a lot of different resources on the Schwab website, so they'll get a monthly statement. They can look at their account balances, etc. Run screens on different funds if they're trying to research which fund to invest in. So there's a lot of different resources on there as well. And then, of course, if they ever want to get out of the Schwab account, they would sell off whatever their positions are within Schwab and then move that money back into their Voya core account. Questions?
Questions for Trampus on the self-directed brokerage?
Let me see if I understand. If I wanted to go and buy a particular stock, I could move money from my account to a Schwab, then buy that individual stock. Is that what you're saying, or I could only buy funds?
It's up to the board. So Schwab will allow all types of investments. There's only a few ineligible investment options within Schwab. So stocks are available, bonds are available, ETFs, mutual funds. So it depends on if the board wants to limit this certain investments to allow the participant to invest in. So if you want to keep it similar to your core account where you're offering mutual funds in your core account, if you want to do the same in a Schwab account, then you can put guardrails around it. But if you wanted to offer all the different types of investments, that's eligible offering as well.
I assume options would not be allowed, options trading would not be allowed, or would that in the Schwab account?
There are options available, so again, that's something
Okay,
that can be
we have to
restricted
decide that, okay.
to not allow.
The reason that we're bringing this forth is we know there's been questions and anticipate more questions on the reduction of options, and others still wanting to go out and invest in a different way. So we think this window makes a lot of sense for consideration. However, we also think it makes sense to put guardrails around it so that there's not option trading. So oftentimes what we see in plans is if there is a self-directed brokerage window available, it's limited to mutual funds or mutual funds and ETFs. And as Trampus alluded to, there's typically an amount or a percentage of the account that can go into that window. Now, what happens in practice is that this is not widely utilized. It's a small subset of the participants that typically go down this path. So usually we put the guardrails in place and just see how it plays out, and then could potentially, reassess adjustments later on.
This is a plan provision that you as the board would be creating. It doesn't exist today. It's an additional provision to your plan to say, we've evaluated it, we're going to allow participants in this plan to, if they choose to, invest in this personal choice retirement account. And you can put whatever guardrails on it you want, as we described. Those investments would not be monitored by the board. It's just any individual doing whatever they want. So typically, that's why boards want to put some guardrails around it, so you don't have a participant taking 100% from the core funds, putting it in a personal choice retirement account, and investing in butterfly option strategies or whatever.
And that may lead to my next question, because from a fiduciary standpoint, obviously we're looking out for the assets of our participants. Now, is there some sort of liability waiver that they would sign to participate in the self-directed brokerage option, or what does that look like for the city of Oklahoma City as an entity, and also the Deferred Compensation Board? Should we allow this?
Defer to Gavin on that.
So, excellent question. We do have some of our clients that ask us to have the individual participants sign a sort of release of liability if they decide to utilize the brokerage account, which then provides you some air cover as fiduciaries to the plan. So that's something that we could put in place. If someone wants to open Schwab, they would sign this form that says, I'm doing this of my own accord. The board is not overseeing my investments. So that should give you some solace, if you will.
So this is one of the biggest things that my members have asked for, is to do this. Not only to be able to manage your own funds, but specifically because they firmly believe that the city has no business telling them how they should be investing their money. Or if they want to take it to a professional wealth advisor, this gives them a chance to go to a professional wealth advisor that can do a dual custody of a large portfolio and really manage this. That's where I hesitate on putting up walls. Or if I want to write a covered call, that's pretty safe to write a covered call. I'm not doing something crazy. I realize most people don't know how to do that or what it is, but if you do, it's not extremely risky, and it's something that somebody would do. Or I would want my wealth advisor to be able to do that if they felt fit, if I'm hiring him to make the fiduciary responsibilities for me. I was hoping we could have that liability, like you said, that waiver. Mm-hmm. That would help. And if we're not going to allow stock purchases, then ETFs, I would definitely be for that we could have an open suite of ETFs that we could invest in.
I would say that it is extremely rare that we have a client that wants to include options. Mutual funds, individual equities, individual bonds, ETFs, that's the predominant selection. Options are few and far between, a client that will select that. So just food for thought.
So just so I hear correctly, you think that the officers that you've talked to would prefer to have like the equity options on there for like the individual stocks, not just funds and potentially ETFs?
That is correct.
Okay.
Yes, I mean, that was.
Yeah, that's the same with us, is that the constituents I've been talking to would prefer to have that, but it's not a large percentage. The vast majority of my phone calls have been on Voya's side of it. But I think that the self-directed account takes away a lot of the pushback that at least I've received on what life looks like come December.
Okay.
So, but I agree with it that if we do, I'd recommend that we do go with it and then put the waiver on it, so that it releases us from our fiduciary responsibility if somebody wants to go off the beaten path.
The FOP members was the same, that the pushback as to what we're getting, this seemed to set it at ease and at least give options if they want options.
And I would add that Board Member Pope is correct. Schwab does allow for independent advisors to access accounts, provide advice to those individuals that want to utilize it. So if there is an avenue to that provided via Schwab.
And from my understanding today, by selecting this, we're not selecting what the guardrails would be. This is just putting that in our plan provisions that we are moving forward. When we do have our final agreement with Voya, we would have a self-directed brokerage option. And so I don't necessarily need to have those guardrails in today. This would be just the next step moving forward. Are we correct in this? Okay.
But I mean, if we're all in agreement that we want to have a self-directed option, we want people to say it's at my choice, my risk. It's not the board's choice. I'm taking on this risk. And mutual funds, ETFs, stocks, bonds, all of those would be available. The only thing that wouldn't be available would be options or other kinds of commodities, exotic trading, something like that. Is there a reason we wouldn't want to just put that forward as kind of our option
Push it forward right now
say,
while we're-
so that everybody knows stocks are going to be an option?
Do you have because we have like the different types, and I forget the phrasing that they use to show like what the different guardrails would be. I know that was in one of the applications that I saw.
It's in the contract. I can get it and read it off. Unfortunately, I don't have a printout of it.
Okay.
And I would encourage the board to make a decision on the guardrails sooner than later, because we're in the middle of the implementation process. We need to execute agreements with Schwab that would detail those guardrails.
Okay.
So Gina actually had a printed off copy, so she's saving me here. But yeah, I list mutual funds, equities, vet equities, exchange traded funds, closed-end mutual funds, and then it has another box for options by itself.
So do we need a recommendation? Can we make a recommendation, or do we need to have discussion?
I believe we can make a recommendation, and we go from there. We'd have discussion, and then just depending on how the vote would go from that point. So I'll look at legal counsel for that. Yeah. Yeah.
I was just asking about the waiver, how it's not in this document. This is just the Schwab document, but before a participant was allowed to go into this, I think you would want them to sign the waiver.
Yes.
Yes.
Agreed.
Or just an understanding that they're taking the risk, making the choices themselves.
Yeah,
Something to that effect. I mean, I guess that's the same thing as a waiver.
the consent.
Right, and so to be clear, that document is something that we develop, our legal department has helped us to develop that. We would ask you all to have a copy of that, be aware of it. It's not a Schwab document, but we're gonna give that to the participant that wants to open the Schwab account.
And that document would presumably waive liability, not just of Voya, but of the board? Or-
That is the goal of the document.
Okay, yes.
I'm not an attorney.
Yeah, that everybody outside of here is, that they're on their own, yeah.
Yep.
Well, I would like to make a motion then that we accept, we add the self-directed brokerage part where they're partnered with Schwab to this plan, and that we open up everything but options to our participants, and that with this caveat that we have a liability waiver in place for each participant that chooses this self-directed option.
Second that, but I'd like to have some discussion.
So we have a motion and a second, but before we take the vote, we'll have a little bit more discussion.
My only question is should we have limit on how much a percentage of their retirement could be moved over to Schwab?
Okay, I had thought about that too, and part of me wanted to say yes, but then I got a whole bunch of people that have wealth money advisors that want to manage they want to take it to their guy and let him manage the whole thing and not take $250,000 or $500,000 and move it over there. They want to manage the whole thing. So I think this waiver protects us, and that makes me feel good about it. But I'm open for discussion. So.
And I'd be open to hearing from both Voya and ACG on this. Typically, what do you see in the plans that you have under management and have there? Like, what sort of percentages do they have?
So the standard percentage is 50% of the balance, but we do have other clients that have different percentages, so that can be a lesser number. You do need to maintain some amount in the core account just to have a place to debit fees, that sort of thing. But we can be flexible on the 50% number.
And then this 50% number, how is that calculated annually? Like if somebody moves moves to a self-directed brokerage account and that grows substantially and the core fund does not grow, how do we keep this 50% number if that was the number?
Yeah, there's not a mechanism to right-size that. So if the account balance in brokerage goes up or down such that the percentage gets out of whack, we're not going to force anyone to sell out or buy in. But the next time they want to transfer money to brokerage, if they didn't have a sufficient percentage, it would block them.
Do we need to, oh, no, Doug, you looked like you were going to say something.
Well, I mean,
You also can adjust this. So you're making a decision today to offer the brokerage. Maybe you start with 50, and then if there's feedback it's too high, low, you can adjust that. In the future, we can then amend the agreement with Schwab to change that percentage.
I haven't seen any that are over 50 or really even approaching 50. So I think if you started with that and saw, my assumption is you're not going to have a whole lot of uptake in this. There might be a handful of people that are pushing for it, and then see where it goes. That's pretty flexible.
So would we, and I thought, look at the clerk here, if we wanted to go ahead and say that 50%, do we need to table that first motion, or can we amend it before we? Do you want to amend your motion?
well, I might say, I mean, again, if this is going to be for a few number of people, it's not a lot. Why not go to something like 60 or 75% for the people who really want to go do their own thing, give them the flexibility. If it does create problems, we could go the other way and rein it back in over time. I don't know.
I was going to recommend 75% was what I was going to do. I mean, I've talked to a lot of people. I've spent more time on this than I could ever possibly imagine. I'm going to be straight honest with y'all. When you Google Voya, I've been beaten up and worked over about the reviews, and I have fought and justified, and I hope y'all come through, because when I read the reviews, it scares me, and I'm trying to do the best for my members, and this was one across the board, well over 100 people I've talked to, and this is what I want, the option to do this, and I think I don't have any analytics behind it, but that 75%, I guess I could do, if I can do an amendment to it that we allow for 75% of our participants' total fund be moved to the self-directed brokerage account.
Do I need to second it?
Well, I was just going to comment before we
Okay.
make a motion. And I'm just looking at the printout that we got, this is for knowledgeable investors. So my only concern is if we're allowing that limit to be a high percentage, we still as a board have a fiduciary duty. And we're making this decision, kind of on the spot as far as the guardrails. And I'm good with what has been recommended as limiting the options out. But just from my own perspective, starting out with a higher percentage, I'm more on the conservative side, and maybe 50% is where I would be comfortable. So that's just my position on just starting this out for your participants.
Well, to counter that, the people that are going to jump into this are going to be the ones that are going to be knowledgeable. The general population is probably going to default back to FOIA and the recommendations that the board made. And if they're out there hard charging and doing a self-directed account, then there's nothing stopping them from opening up an account with E-Trade or whatever and trading stocks in general. And we don't put guardrails on that. It's just money that's payroll deducted into a pre-tax dollar. So I see merits on both sides of it. I'm more leaning on his side. The people that I have rang my phone off the hook are people that are much more knowledgeable in this than I am. And so I'm not necessarily sure, but it's up to 75%. It's not, that's up to the individual employee what they want to put into their self-directed account, so.
And as a board, in addition to the letter that Voya would be preparing, the liability waiver, and that there is an education piece that says, this is not play money, this is risky. And just that is part of our, because I agree we do have that fiduciary duty, but I think it has to fit in somewhere with that.
And I would add that we are diligent about not promoting or recommending the usage of the brokerage. You educate your participants, your employees, this is available, this is how it works. But as a board, as a record keeper, as investment consultants, we're not suggesting someone should do this. It's just available, you're educating them. So.
I would agree with that, and just so y'all know that when I speak to my members, and that's part of the job as a wellness unit, is to provide this financial piece for that. Our first recommendation is the target date funds. That's where we would want our members to move to, but I want them to know that they have this option, but I'm absolutely not promoting that we leave and go to this self-directed brokerage. And even at the academy level, we start at the very first few days of the academy. I'm going to promote the target date funds for our brand new recruits. And then as they go, obviously this is going to be a stated option. If they want to move to it, they're going to move it. But I don't foresee a whole lot of people going to this, just like what he was saying. It's going to be some highly educated people that are already in the stock market or they already have money advisors. And that's something that's growing with the Oklahoma City Police Department is we have all these wealth advisors now that we have community partners with that many of our members are using right now, and that's going to continue to grow, and it will really grow, I believe, if we have the self-directed brokerage part.
So it's up to me? I still like the 50%. I think it's reasonable to start out. We can increase it as we go on if that's the case we need to. That seems responsible.
So do we have a couple motions? I made a motion, then he seconded, and then I kind of tried to make an amendment to it, so I don't know if we got out of whack or what.
Yeah, so we have the amended motion was for 75%, and what we would need is a second on that.
I'm in favor of giving people the option to do it. If they're taking responsibility for their investments, I think we should give them the option. So I would second the 75%.
And we don't have to do anything with the first motion because he's amended it? Okay.
I don't know if we can do this, clerk, but could we vote on the percentage first and then vote on the directed piece? So if people vote against the 75%, they're not voting against the self-directed option. Like, I don't know if that's worth splitting it up into two pieces. Maybe we vote first to have the self-directed option with no options available, and then we have a second vote for what percentage is allowed. Would that be okay?
I am in agreement that that would meet our needs.
So we have a motion to do that, yeah.
Okay, so do I need to make an amendment or just do a new motion, or can I cancel it? I don't know the rule of order for this. I'm going to restate my motion. So the first motion I'm going to make is that we add the self-directed brokerage account to our portfolio. That opens up the stock market, everything except the options and equities as they had stated. So hopefully that's enough.
And I will clearly second that.
So we have a motion and a second, and we have had discussion.
Does that include the waiver with that?
Yes, that does include the waiver of liability that Voya is going to provide us.
And I think that could be included in our agreement to make sure we do that. So that doesn't necessarily have to be a board action to do that.
Yeah, a couple of ours are not coming up.
Oh, go to computer.
Likely.
We'll just do some voice voting.
Okay.
Trustee Aguilar. Trustee Dowler.
Yes.
Trustee Gibson.
Yes.
Trustee Pope.
Yes.
Trustee Boggs or Chairman Boggs.
Aye. And the motion passes.
Yes. Are we wanting?
So you're going to make your second motion.
My second motion is that we allow for 75% of our participants' funds to be invested into the self-directed brokerage account.
My second.
Oh,
Yeah, I think we're having issues on the computer. We may just have to do the voice again.
yeah. Can everybody refresh?
Okay. You said refresh. That worked on mine?
That did it for mine.
How did I get incognito?
Yeah, when I refreshed, mine came up.
Apparent-
They kicked you
And
out.
apparently, I went too far.
What's showing up on my screen is the approved, moved by, second by. Do I hit yes? Is that it?
No. Okay, we're just going to have to do some voice voting. So give me just a second. All right, Trustee Madera?
This is for the self-directed broker if we're going to add it to the plan, correct? Or this is the percentage?
This is the percentage.
75%.
No.
Trustee Dowler?
Yes.
Trustee Gibson?
Yes.
Trustee Aguilar?
No.
Trustee Weller?
Yes.
Trustee Pope?
Yes.
Trustee Yaw?
Yes.
And 2 nays. Oh, Trustee Boggs?
Yes.
Sorry. So there are 2 nays.
Okay. And so it passes with 2 nays. And 1, 2, 3, 4, 5, 6 yeses.
I can't.
Okay, so that we would move on from that. Thank you, everyone, for all the hard work that goes into that. Do we have any comments from the board?
I just have one question. We have a recruit academy that's starting September, which is going to be prior to any of this implementation. Are we going to allow Nationwide and Mission Square to come in and do their pitches and start the accounts, and then knowing that we're going to be moving them over in December, or do we call Voya and have Voya give the spiel? September 4th is when the talk is, I believe.
Gina, do you want to address?
Come on, Gina.
We're the same way for the PD, but we've chose not to even allow them to come in until towards the very end of the academy. So it may work itself out.
Yeah, we
where
may
they
just,
wouldn't-
if that's what you guys are doing, then
Yeah.
I'll advise the training staff that we just defer it until.
It would probably be cleaner at this point not to have any enrollments until we make this transition. They are still allowed every 2 weeks to the new hire orientation, but we haven't had a lot of new enrollments at this point, so
Okay, I'll advise
I think
them.
it's something with you and your recruiting team.
Okay.
Was there the option, I thought there was going to be an open enrollment, though, option, right, in November?
Correct. Open enrollment will be the last week in October,
Okay.
in which Voya will be there to help answer questions, and we can start setting up accounts to
Okay,
deduct
we may
maybe
just
in
have them
December at
come to
that
the.
point.
Okay.
Any other comments from the board? Comments from staff? Do we have any citizens that signed up? I would like to just say a thank you to Gina and her staff, because there's been a lot of work going on in the background for this. And so definitely want to send the appreciation to the retirement system staff for that. And with that, we are adjourned at 4:03 p.m.